Everyone, welcome back to the channel. Today we're diving into one of the most iconic books on investing, A Random Walk Down Wall Street by Burton Malkiel. This book challenges the way we think about the stock market and brings a whole new perspective on how we should approach investing. Malkiel argues that stock market is unpredictable and no one can consistently beat the market over time. And guess what? He's going to explain why in the most accessible way possible. So grab a cup of coffee and let's walk through Malkiel's random walk of investing. First thing first, what exactly does Malkiel mean by random walk? Well, it is a metaphor. Imagine a drunk person trying to walk straight. They're stumbling around, going this way and that, and you can't predict which way they will go next. Malkiel compares this random stumbling to how stock prices move. No one really knows what is going to happen next. The market's ups and downs are as unpredictable as that drunk walker. Despite this randomness, many investors believe they can predict the future of the stocks based on the historical data or gut feelings. Malkiel says that's simply not the case. Over time, stock prices follow a random path, which is why trying to beat the market consistently is next to impossible. Now, let's talk about a concept that Malkiel is really famous for, the efficient market hypothesis, or EMH. Here is the idea. The stock market at any given time reflects all available information. So, if a company is doing well, the stock price will already reflect that. If bad news comes out, the stock price will drop immediately to reflect that too. There is no secret formula or hidden information that you can use to get ahead. Everyone has access to the same information, and that makes the market efficient. Think of it this way. If you hear that Apple is about to launch a new product and you rush out to buy stock, it's likely that other investors have already made that move. By the time you act, the stock prices has already adjusted to reflect the news. So, if the market is efficient, does not mean if the market is efficient, does that mean actively picking stocks is a waste of time? Malkiel thinks so. He dives deep into the world of active investing, where people try to pick stocks that will outperform the market and shows why it really works in the long run. Active investors, like those who run hedge funds or mutual funds, often charge high fees to manage your money. But after factoring in those fees, they usually end up doing worse than the market averages. Malkiel's advice: stop trying to outsmart the market. Instead, you can get better returns with a simple strategy. Invest in low cost, diversified index funds that track the market as a whole. Next up is diversification, one of the core principles of Malkiel's investment philosophy. Malkiel argues that the best way to reduce risk is not to try pick the next big stock, but rather to diversify your investments. By owning a variety of stocks across industries, countries, and asset types, you protect yourself from huge losses when one stock or sector tanks. Think of it like a balanced diet. Instead of eating the same thing every day, mix it up. That way, if one food does not agree with you, the others will still keep you going. So, instead of putting all your eggs in one basket, Malkiel says spread them out, own a variety of investments, and you will be in a much better position in the long run. So, now let's talk about patience. Malkiel's philosophy on investing is not about making quick money. It is about long-term success. He emphasizes the stock market grows over time. Sure, there will be crashes and dips along the way, but history shows that stock market tends to rebound and grow over the long run. That's why Malkiel is a big believer in buying and holding index funds. It is simple, it is efficient, and it is built to weather the ups and downs. So, what is the takeaway from a random walk down Wall Street? Malkiel teaches us that stock market is not as complicated as many market it ought to be. Stop trying to predict the unpredictable, diversify your investments, and focus on long-term growth, not short-term gains. And focus on long-term growth and not short-term gains. The stock market is like a random walk, and your job is to keep it simple, steady, and smart. Don't try to oversmart it. Don't try to outsmart it. Let it work for you instead. If you're looking to invest for the long haul and let your money grow, Malkiel's advice is a game changer. If you enjoyed this video, don't forget to like, subscribe, and share it with someone who needs a little investing wisdom. And as always, drop your thoughts or questions in the comments below. I would love to hear how you are approaching the market. Thanks for watching, and remember, sometimes the simplest path is the best path when it comes to investing.